Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. The opinions expressed in the program by the host and the guests are their personal opinions only. Remember, feel free to subscribe and share with like-minded friends. My name is Deryck Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gaur, Managing Director of State Street Digital Assets. Good morning, good afternoon, good evening, wherever you are in the world, and welcome along to another episode of Beyond Bitcoin. Today, we've got the topic of the month, possibly the topic of the decade in this particular space. And here with me today, of course, as always, is my friend and colleague, Nitin Gaur. Good morning, Nitin.
Hey, Deryck. Good evening to you. I'm calling from Texas and you're from in Australia. So always a great time difference for both of us. Glad to be here.
Terrific. Hey, Ethereum, the merge.
And the surge and the verge and the purge. It's like a whole, rhythmic use of terms here.
It's fantastic. You know, it reminds me of a whole variety of Star Trek episodes. So I really don't know whether the programmers have done this or the marketing people have done the spin, but it's brilliant. But underneath these things, each one of them means something. And so today, I thought you and I might talk about not just the technical aspect, but also the financial aspect, because we've obviously seen the value of a Ethereum token go from $1,050 to about $1,650 odd today. And that hasn't represented the growth of the market in the last 30 days. It's outperformed the market. Why? So let's go through and discuss this. But for those listening, maybe let's just clarify what Ethereum is to begin with. So Ethereum is a decentralized global software platform that's powered by blockchain technology. Ethereum is scalable, programmable, secure, and decentralized, and it natively supports smart contracts, which is the essential tool behind the decentralized applications. By the way, it has about 3,000 dApps, decentralized applications, operating on it. So based upon our theory that each one of these major blockchains is a sovereign state, I would argue that the Ethereum sovereign state is the biggest in the world. So let's have a look. It's got 126 million tokens on issue. Its price is around 1,500 US ago, 1,600. I've calculated at 1,500, and that makes it about $230 odd billion of capitalization. It has 200,000 validators. So that's computers there that are validating the transaction of this proof of work process. So to give you an idea of proportion, Solana has 1,800 validators. But, and this is part of the reason for the Verge and the Splurge, but the transactions per second sit at 13.9 transactions per second. And Solana sits at about 1,055 transactions per second. So it's slow. So Vitalik has outlined each one of these steps, and he's defined them as follows. The merge, which he says now becomes a deflationary asset with the reduced issuance, cuts power usage by a mighty 99.95%. The date of this upgrade is due on the 19th of September 2022 at the time of his speech. The surge, this will significantly increase the network's scalability. This is where multi-sharding comes in, Nitin. And that's when they anticipate that they'll obtain 100,000 transactions per second. So let's put that in proportion. Visa and MasterCard do 50 to 60,000 transactions per second at Christmas time. So it should be a rate which is more than adequate of transacting the global transaction rates. The Verge, which is the next one after the surge, is really designed to optimize the storage of Ethereum and to help reduce node size, ultimately to assist Ethereum to become more scalable again. And then the Purge reduces the hard drive space needed for validators. This eliminates historical data and bad debts and it streamlines storage, which in turn reduces the network congestion. This all makes sense, doesn't it? They're making it more elegant, they're making it easier to use as a validator, and they're making it faster. And then finally, the splurge really is a series of miscellaneous smaller upgrades which ensure the network runs smoothly, with all the prior 4 upgrades done. A really very well considered development program, because they're not basically putting all this in one go. They're releasing it step by step. Firstly, this major step now, which is the merge, goes from being proof of work to proof of stake. And this is the big breakthrough. And so the question I've got to begin with, Nitin, is this going to solve the famous blockchain dilemma, or it's a trilemma, in fact? And that is strong security, high speed, and low cost. What do you think?
Yeah, no, I think that's a great segue into what I was going to talk about, Deryck. That this transition, as you described, merge, which basically sort of today, this implies that you're changing from one consensus mechanism. You're changing the entire compute infrastructure, the way we keep the blocks and keep the transaction secure. At the end of the day, all Ethereum provides is secure block size. That's the main value proposition. And if you were to go back in history, the entire cycle of introducing the stateless client, which is the next element of the fact that now that you are going from proof of work, which is computationally expensive, to proof of stake, which is meant to be more computationally efficient, then relies upon many layer 2 to say, hey, I can make it much more, transaction will be super cheap, and I will let people consume, all you can eat transactions essentially, which makes things cheaper. And then the idea behind Verge is that you issue stateless clients. That implies that the users wouldn't need to keep a lot of data on the computers, because the network validators, these, would have to have that function. And historically, if you look at what we have done with this shift from mainframe to client server technology, is essentially the same thing. We, instead of relying upon keeping one massive sort of box of processing and data, we said, let's go and distribute the data. So, and we've gone through this cyclical process in history, if I were to go back and recall the history. And as I'm witnessing this whole thing to say, eventually I want to streamline storage, I want to lessen network traffic, there is something called a Brewer's theorem. I think we discussed this in our scalability topic, which is something called a CAP theorem, which stands for consistency, availability, and partition awareness. And the thesis was that any system can only achieve 2, but not all 3 of these properties. So system can either be consistent, system can be partition aware, which is how you distribute the data across multiple systems. And for them to be consistent implies that I'm keeping the data in multiple places, which means if I update one piece of data, I have to go and update all the other pieces that's scattered around the network. And that became a challenge, because if you do a lot of updates, there's a lot of network traffic that has to go and update all these little bits and pieces of data that's sitting everywhere else. And that consumes energy, because that consumes network IO, which is network input output. That's essentially where they're heading in that direction. And the trilemma, which is an extrapolation of this Brewer's theorem or the CAP theorem, is around decentralization, consistency, and safety. And I think that the theorem, which has not been unproved yet, is just laws of physics, that you cannot achieve all 3 at the same time. So something's got to give. And I view this as an enormous opportunity, because while we have gone through the cycle of centralized computing to distributed computing, which is what we see in the client server space, before we went down the path of vertically integrating all the services into cloud, which we went back to the old model, but in a bit more fragmented way. From a computing perspective, I see this as a massive opportunity, because this has not been attempted in blockchain context before. Of course, there are maximalists, and we can talk about that in a few. But I see this as an economic shift, which is risk and opportunity, that you suddenly now shifting the incentive economic system from proof of work, which relied upon mining, that relies upon having extensive amount of power, to now staking. So it becomes a model where you have to, it's like an oligarchy, oligarchy rather, where you have to have certain assets to participate in the system. In some cases, you may have to, whatever little you've earned So you're sort of breaking some of the tenets of decentralization, some of the tenets for the larger masses to earn to participate in this economic system. Second thing is the technology shift, which is enabled by this economic shift with fundamental changes in this technical framework that we're talking about that enables security. So we're moving from proof of work to proof of stake, and that fundamentally changes the level of how we secure the network, which today was a tried and proven method that we have seen with Bitcoin. Yes, it's controversial. It has an ESG component. It has conversations around massive power usage. But that aside, there's a reason why that amount of power is used, because it has an incentive mechanism to thwart anybody to be able to. So while those barriers are gone, you're giving up on a few things, whether it's in order to receive and achieve the higher transaction throughput, as you mentioned. So I've always discussed this at an intellectual level as an opportunity and a risk. So either Ethereum will do really, really well, or it'll begin to start showing challenges that we have seen again with the bridges and many of the interoperability technologies, because they haven't really solved the entire DCS or trilemma per se. I'll pause here, Deryck, to see if that makes sense.
Yeah, it does. And I think the other part of them being able to run the new Verge program, to be able to run both staking and validation nodes separately, or together if wanted, but separately. And their intention to really make the programming a lot more elegant should improve both speed, efficiency, and the number of people capable of becoming stakers around the world. Because if you become a staker, the economics become, well, what looks like quite attractive economics. And you may find that there'll be very large aggregators of staking, in which case they will pay a percentage to get your Ethereum on board, and you'll get a smaller percentage of APY, but won't be a staker. So you might see that. Well, that's kind of like interest, frankly, that you'd be paid on your Ethereum wherever you keep it if you want to share it with these, or you can become a staker yourself, which means you get interest on it. So it can also be seen as a way of democratizing the economics of Ethereum and seeing a return.
And that is the intention, right? If you look at the narrative behind this merge, right? Its one objective was to keep the current projects alive. Ethereum by far has the largest developer ecosystem. You mentioned 3,000 decentralized applications. In fact, I think there are a bit more, and many of them actually moved to other ecosystems because it became too congested, ergo became too expensive to process transactions. Especially NFT projects have moved on to other ecosystem because it was too expensive to do any processing. And I think the financial ecosystem moved to layer 2 because Ethereum became expensive. So one of the narratives to preserve that rich ecosystem is cheaper, faster, better. That's the obvious. Better for the environment. That's an ESG feather on the cap. And that's where things become interesting. But now with much more diverse opinion between the Ethereum maximalist and Bitcoin maximalist, and better for scale. Scalability element. But as far as the egalitarian component goes, which is true decentralization, I think what they've done is one of the element of choosing these validators, right? Which is one which gets the ability to propose a block and get rewarded for it, is cyclical in nature, where at random you have pools. You have to have 32 ETH, which is quite expensive for an ordinary person to just go and acquire and achieve. Or they become part of a pool that pools people's assets, and that's essentially staking. These staking pools then get to, but then you're picked. So if you have, like, say, 1,024 of these pools, then at random you may get picked. 8 of them get picked, which means you have to wait for your turn to get, to be able to get picked, to be able to provide security to, to the network. So the question then becomes, one is patience capital, 2 is the economics of it. Like today, it's a pretty simple economics that you mine and you get the Ethereum. The Ethereum is used for tolling mechanism, which is to pay for transactions. Suddenly now you're in this game where the validators do get some, where the post-merge ETH issuance will drop, I think, about 0.6 million per year. And with similar, 2.7 million ETH burned every year, which is through EIP 1559, which was meant to provide a bit more a proper estimation for gas fees, meaning that you have a net 2.1 million ETH burned per year, which is minus 7% of the overall supply, which diminishes over time. And the hope there is that over time this becomes a lot cheaper. And again, driving ETH miner out of business. Suddenly you have the stakers now, which take on the dominant role. What I don't know, like any oligarchy, is suddenly now you'll have a few folks who can dominate the space in terms of and provide a renting capability, which I think in many cases, while provides a diverse, decentralized computing platform, may not necessarily equate to a much more egalitarian access platform, if that makes sense. Because now you're dealing with just a few rich folks or entities who have the technical know-hows and have the ability to amass these staking tokens to be able to host staking pools that they can participate in that economic system, which is in many ways similar to, like, even mining was hard. I mean, you don't, it's akin to, except that it's become easier than mining now. And I would say that that's a plus on Ethereum's part, that you can join a pool as opposed to, being a part of some mining rig that was inaccessible to most individuals, and you had to go through some professional entity or some sort of company that actually had the entire apparatus to mine per se. So there's a little bit of that change. I think time will tell as to how efficient this is. That next thing you know, there are 1,000 pools, running the whole network, and that's a lot of dependency on 1,000 individuals if this becomes hugely successful.
It's certainly a shift from the miners, which very few people today would want to enter because of the requirement of the specialized equipment and the very competitive aspect of it. So even if I didn't want to stake and I want to keep my Ethereum on, say, a network like Crypto.com or Binance, Binance will pay 4.3% because it's getting money at about 9% per annum for staking it. So it's giving you money as a return on your investment of ETH. So even if you're not participating, you can generate income by just simply parking your ETH. But if you do participate, it's quite interesting. So if you're a staker in the new version, where both the at the surge stage, when the full transactions are in place, and you are both a validator and a staker, or you can be just a staker, it's starting to look a little bit like economics that we're used to on an investment. So by example, the burn is now seeing the ETH issuance drop from what was 4.3% of new issuance down to 0.43% of new issuance, and the burn rate being higher. So as you said, there was a net reduction of, I think you said, about 2.1 odd million tokens per annum. So a burn is like a share buyback. There's less shares every year. So your share value is increasing. So the burn is a share buyback. Then you've got a yield, which I think to recently was around 9%, may well go up depending on demand and supply. But let's just say the yield is 9% that you're getting on it. Well, that's a pretty damn good yield you're getting on your stock. You can put that into a discounted cash flow and work out the value of that, both of the Ethereum token and also of your need to put it there. In fact, it starts to sound like a very profitable bond. So that's the financial aspect. What do you think about that?
One thing is interesting is that Ethereum, from an asset class perspective, as you know, CFTC had labeled as utility. That is, it was a utility because it was tolling mechanism. Suddenly now it's staking and the yield and investment objectives. I think the nature of ETH may not exactly be a commodity anymore, or it may not be a utility anymore. It might as well be, staking may change the nature of the asset class, which may have an interesting regulatory and compliance implications on the asset itself. Because now you have an asset, just like you have cash. And if you mentioned the word bond, you mentioned the term stocks, which is you're expecting a return on that stock. Suddenly now the definition of that asset class changes. And the interesting thing in this entire ecosystem, which I think, as you have seen today, Robinhood was slapped 30 million And you had all kinds of interesting challenges this week in terms of regulatory action and enforcement action being imposed on various players. This week was a very interesting week from that perspective. What would be interesting to see is how this changes. This is post-merge and maybe going towards the surge a year or 2 years from now. Will this become a challenge and it's a matter of a few pools going rogue? That happens all the time. You give your ETH to a staking pool and they run away with it. And what do you do, when that happens? What is the definition of that asset class? And what is the definition of then the asset class that depends upon this asset class? Do they become a derivative? Do they inherit some of the underlying capabilities because they're running Ethereum? I think it'll be an interesting evolution to see. And that's why I call this an opportunity and a risk, that that economic shift changes the defining role of Ether per se. And more importantly, I always question this too, as Solana, Cardano, and Algorand, they all are in some form or fashion using this notion of proof of stake,
Yes.
right? And so now you're actually level playing field with the other variations of proof of stake who are in the business. And in general, I think at a broad level, and I read an interesting article that the asset, locked in the sense that the total amount of assets in proof of work and proof of stake will be drastically different now. That suddenly now Bitcoin is the only proof of work. And there's another development in Ethereum, which I'll talk about in a few minutes, but suddenly now Bitcoin is the only proof of work asset that's remaining, and that's today the lion's share of the crypto industry, and the rest now moves towards proof of stake, which means on the long run, this becomes a commodity from an attractiveness of an asset class. And while it provides certain level of synergy between the two, I think it'll be interesting to see the imbalance and the asset differential between the proof of work and proof of stake.
And now, Nitin, it's ESG. And so therefore it's not burning energy. So a lot of big institutional investors can invest in it now. So you're going to see this investment dynamic occur where Ethereum is going to potentially increase substantially in price. Will that impact the transaction fees? And will that impact the community? Will it suffer from its own success, do you think?
Just because ETH is deflationary and this surge really refers to layer 2 protocols, and all the most busy Uniswap and Aave have moved to Polygon, which is a layer 2 protocol.
Yes.
My only contention in this entire debate was that if you're moving to proof of stake, we should not need layer 2 for scalability. We could use a layer 2 for privacy preservation using zero-knowledge proof, ZK Snark. There's enormous amount of interesting technologies out there because layer 2 in many cases are centralized infrastructures. And so the question is that while the ETH2 would lead to, let's say, 10, 15,000 transactions per second, which, by the way, is adequate for most systems, including payment systems. You don't have to have the scale of 50,000 or 100,000, which is what you mentioned with Visa and MasterCard, with the exception of Christmas sort of time. But most applications don't need that level of processing capability. So the question is, the surge, which refers to making the Ethereum layer 2 blockchains even more affordable, to me is a moot point. I just don't, I'm still questioning the role of layer 2, and unless it's only privacy preservation and adding a layer of privacy, which is what ZKPs do or zero knowledge proofs do. I think there's going to be a shift, and this whole notion of 6,000, I still have to look at the number, which I think is overly optimistic, because the more expensive ETH gets, it'll attract now the fact that you're dealing with smaller pools as opposed to proof of work. You are giving up on some element of security, the DCS, remember the trilemma that we talked about. You're giving some level of that security because now the pools have to be tasked with securing the infrastructure, and they have to, be in line. So I think it'll be interesting to see how their voting process goes per se. But I'm questioning a few things. Again, that's why I'm calling it a risk. And again, the analogy has always been that changing the engine on a plane while the plane is flying. Well, that sounds risky. Even though they're going through, a few test networks. I think next week they're going Gurley, which is another test network before they actually go into the main net. So yeah, I think I'm excited. I am optimistic, but I'm also, cautiously optimistic that all works out okay. And if not, then it'll be a use case and case study for future blockchains per se.
Well, but also, if it implodes, which would be just the worst case scenario, you're talking about a major part of decentralized finance being put on hold or inconvenienced or shut down for a period of time. It'd be a disaster. So they have an enormous responsibility on their shoulders to get this right. Not just to get this right for elegance purposes and improvement in speed, but to get it right with the 3,000 plus applications that have been built on it already, and those people that are transacting, trading and dealing on those applications. So it certainly is probably, well, I'm not sure what is a more interesting or more important transaction that's in development program that's occurring or has occurred for the last, 5 years or more, and maybe it might occur for the next 5 years. This is it.
So I think from computer science perspective, and
if there's a programmer spectator sport, Nitin, this is the programmer spectator sport.
I couldn't agree more. As a technologist, as for computer science professionals, this is such an interesting moment, because remember, there is history from 2015 onwards, right? On the entire sort of blockchain, and that data those transactions will be preserved, the validation, verification of the transaction as the merge happens. There's a time when the difficulty bomb or the hashing algorithm, it'll be forced to move from the proof of work coin to a proof of stake coin. There'll be that little induced, difficulty bomb that will force them to move into this whole thing. Imagine moving all the data sets, all the chains with that to the new system.
Yes.
And then relying upon the proof of stake system to then secure and verify and validate the historical context, which I think is such an interesting thing, both from a cryptography perspective, but also in terms of, I'm just thinking of what could go wrong. And I've done a lot of search in this space, besides my own intellectual exercise, and I haven't seen a lot of discussions yet in the cryptosphere in terms of what could go wrong here. And I think we should discuss that as a pragmatic approach.
Look, I'm imagine they're discussing that at length at the Ethereum Foundation on a constant basis over a long period of time. So let's just assume for a moment it goes right. What impact is it going to have on Solana, on Avalanche, on Polkadot particularly? And as you mentioned before, on layer 2 protocols, if apart from security or zero knowledge proof purposes, maybe layer 2 protocols become irrelevant. This is going to be a reshuffling of the status of some of these other blockchains. They'll still have a purpose for being, though, because they're designed in different ways to formulate different solutions. But do you think it'll have an impact on the likes of Solana and co?
I think so too. I think few things, right? One is many of us don't believe, and I'm certainly not a maximalist, that there'll be one chain to rule them all. We'll have diversity of each of the chain provides a unique element. Avalanche came up with this own subnetting structure to provide scalability, which goes above and beyond the traditional proof of stake structures. And then you have Cardano, which has been at this for quite some time. Then you have Algorand, which sort of has its own mechanism, from some really smart people. And I think each of them have tried to carve a niche for themselves, right? Some of them are focusing on NFTs only. Like if you look at Dapper Labs, the Flow protocol, which is another layer 1, purely also proof of stake, purely focuses on NFT ecosystems. Algorand is going after the Hedera, and Algorand going after the quasi-enterprise use cases to be attractive to the large enterprises, to be able to get in. So I think each of these chains are going for the specialization, and they'll find their niche. And on the long run, if you look at where I think this gets interesting is the EVM or Ethereum virtual machine based structures. There's a certain level of interoperability at the machine level, which means that if you have an EVM based smart contract and ZK EVM, which is what Polygon is coming up with, makes it even more portable for these ecosystems to exist or these specialized programs to exist in the various ecosystems. And I think, if not anything else, that technical evolution is generally good for the industry, that people are thinking about the fact that, yes, if all of them have same economic structures, don't I want to be able to build the same house of business in every ecosystem if it provides a value, provides a service, and ability for me to be able to monetize in every ecosystem? as a specialized function. And I think that will only promote a much more convergence, even if it's just purely between the proof of stake systems. I think it'll be a good thing for the industry, because now you have diversity, you have a choice. If things don't work in one, you can always switch over to the other one, and you can be able to provide, it lowers the cost of switching, which in economic terms is always a great thing for the consumers, I think.
Yeah. And also considering that, one has to also remember that there's a global community out there. We keep thinking about the US, Australia, the UK, Europe, etc. But there's South Korea and right through Northern Asia, then of course China and Africa, and as we just last week when we were discussing Africa, we're seeing different development programs occur there based upon different blockchains, and so there's still a lot of requirement for many different blockchain solutions along the way and hopefully that will positively support the community in one form or other. So it's a brighter future, and the aeroplane is getting its engine changed midway. I'd like to think they flew up there with an engine, Nitin.
I think so,
sitting
yeah.
in the other wing as they're working on it. but nonetheless, it's getting changed midway. What do you see as that brighter future? Reduce cost, high
reduce cost.
Do you think that's those are the anchors that are holding back DeFi and Web 3.0 at the moment?
So besides the fact that it's going to be cheaper and it's better and it'll attract more projects and the cost of doing business becomes a lot less, including for us as consumers, because we who are using these services are oftentimes, I stop myself in transferring USDC because it's cost me $50 to transfer $50, which doesn't make any economic sense. Yes. So it'll certainly fuel a lot more utility of the network, which is such a great thing, that we all are able to use this without thinking about transaction costs, which has been a massive impediment, which became, again, Ethereum became victim of its own success, that it became so popular that now it became too expensive. And what we talked about, that moving money is expensive on traditional finance turned around and say, hey, you're paying $170 to move something on Ethereum, and that's not exactly cheap. And so I think from that perspective, I think that the utility of this certainly goes up. The entire process to change something mid-flight, right, which is this whole process, will, if this really goes well, becomes an industry standard that people will begin to now follow the same sort of steps, and over time it speeds things up, and ability to change protocols or faulty protocols or inefficient protocols in future becomes quite relevant for all the networks. So they're setting a stage, and likewise any failures are also an opportunity to learn from this perspective. So I'm very optimistic about this in either way, from learning perspective, and also if this goes really well, then the utilitarian element of this becomes really, really dominant, which is the hope here, I think.
Yep, I agree too. I'm very excited about this. We are constantly discussing Web 3.0, the opportunities with Web 3.0, Metaverse, DeFi. When you realize the majority of these are getting transacted upon Ethereum, and this is an opportunity to enable those major new technologies to expand at a rapid rate, this is a massive breakthrough that's coming, assuming they get it right. So that's for us this week. I've got to say that I'm excited about Ethereum, obviously, as I think so is Nitin here. We don't know whether it's going to be worth $6,100 a token, that the nice person at Bloomberg is, but like normal, we're just surmising our ideas about this particular space. But what it is going to become ESG supportive. It's going to become a lot more efficient, and I think it's going to become a lot more democratized through this process. And all of those are good things. So until next week, Nitin, where we'll resolve another major issue or uncover another new technology. I'll see you then.
Next week it'll be interesting to see what happens. Again, there's never a dull moment. There's so much going on in the industry. But looking forward to it, Deryck. These podcasts, it's a learning opportunity for all of us, because we figure out what we want to speak. So I think it's always a fun and pleasurable experience.
Good on you. Agreed to. See you next week.
Take care. Bye.
We hope you enjoyed our weekly conversation. If If you have any questions, comments, or suggested topics, please contact Nitin Gaur or myself on the emails displayed here or via our LinkedIn profiles. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week.